Hi folks, Chuck Gibson from Financial Perspectives here. From a market perspective, last week was a hoot, wasn't it? You just gotta love Fed weeks. There's just nothing more enjoyable in life. Well, of course, a root canal without Novocaine comes in a close second. With all the craziness that occurred, I thought it'd be helpful to do a quick stock market video to bring everyone up to speed since we ended the week at an important juncture. To keep this short, I will only be covering the US markets since they are really the only ones left across the globe that have not yet started a new downtrend. Of course, there are always a few exceptions, but for the most part, global stock investing is tepid at best. No need to bring up the macro causes because they have been talked about at length. It is just a matter of when it will finally roost here in the US. Let's first take a look at the S&P 500 index. As you can see, we peaked in late July with negative RSI momentum divergence, had a quick 6.5% pullback, and began to trade within this range. Each of the 4 times we attempted to move higher, the bears took control and pushed prices back down. Conversely, each of the 3 times sellers tried to push price lower, it found support as the bulls stepped in and took control. Friday's close was not encouraging for stockholders, as we would have preferred to see the final closing price end higher. While not at the absolute low of the day, closes near the low on big volume increases the probability you will see follow through on the downside come Monday. There's not much downside left before price would break down below the trading range. So, for investors' sake, let's hope the bulls let it be known that they are still in the game. If you let your eyes drift to the bottom pane, you will see the volume bars. What has to concern the bulls is the predominance of activity in the range have been large red, which are selling bars, which is indicative of institutional selling. As of this weekend, we are watching a tug of war between the buyers and sellers. We paid our tickets sitting in the audience, waiting for the victor to emerge. I doubt we'll have to wait much longer, as I think we'll get our answer this coming week. For those with keen eyesight or great memory, this scenario should seem vaguely familiar. Updating the chart and looking left, you can see an eerily similar setup developed in Q4 of last year. Negative RSI momentum divergence, quick initial flush down, followed by a choppy range-bound period. We know the final outcome. The only significant technical difference between the 2 periods is that last year, price was chopping around a flat 200-day moving average and below a declining 50-day moving average. This sort of setup gives a slight edge to the bears as the winner out of that consolidation range. And that's how it played out. Today is markedly different as price sits above a rising 200-day moving average and just under a rising 50-day moving average. This setup provides that same slight edge except to the bulls. I can't leave this chart without mentioning volume, as it is contradicting the above bullish outcome thesis and instead points to further downside. Moving our view over to the US small cap stocks, they look much weaker, and it's easy to see why we've been avoiding them for more than a year now. Unlike the S&P 500 after last year's sell-off, price has not gone on to make new all-time highs. In fact, the index has gone nowhere since mid-January and has interestingly formed this topping pattern, which has a pattern objective, once confirmed, down here at T1, some 10% below Friday's close. Volume in the bottom pane is telling a strong story that the bears are in charge, and there's just no reason to own US small cap stocks until the overall technical profile has changed. Switching our view over to my final chart of the perennial US sector performance leader technology, you can see it looks very similar to the broader S&P 500 index, consolidating between support and resistance and rising 50 and 200-day moving averages. While less than last year's large volume sell-off profile, the recent volume patterns still reflect institutional distribution. A breakdown below 180 support level points to further downside with a target down at 165, almost 9% below where we closed Friday. In closing, it's important to note this video is looking at the current short to intermediate term conditions. Since we take a longer term investment approach, any weakness now should be viewed as nothing more than normal volatility. While I did not show them, the longer term views of the S&P 500 and the technology index are still in uptrends, and while any short-term weakness should be viewed as a buying opportunity. That being said, this does not hold true for small caps, and they have not gone on to make a higher high after the last year's sell-off. As such, owners of the small cap stock index should be looking at any break in confirmation of the neckline of the current topping pattern as a signal to reduce or eliminate risk. Well, let's call it a wrap. Grab some popcorn and try and enjoy the show, as the circus has not yet ended. My guess is probably not by a long shot, unfortunately. God forbid it runs right into next year's election. Anyway, I appreciate you taking the time out of your busy schedules to listen, and I hope you have a great week.